How's it going, everyone? I'm Adrian Gonzalez, founder of AG Squared Holdings, and today we're going to walk through one of the deals I've analyzed in the past to give you a real look at the types of opportunities I pursue and how I evaluate them. First, as you can see on my website, every deal I analyze lives here, whether I've discarded it, rejected it, or approved it. Each one follows the same layout. We have the summary, the investment thesis, the returns, the market analysis, the strategy I plan to employ, the finances, how I would raise and deploy capital, a bit about myself, and always a section around the risks and how I mitigate them. Before we go further, make note, this is fully educational. This is not an active deal, and I am not actively raising capital for this. If you're interested in learning more about actual deals, reach out so we can discuss your goals and explore how we might work together. For any experienced investors watching, here are the 5 metrics you should focus on from the get-go. The LP IRR, or internal rate of return, the equity multiple, the average annual cash-on-cash return, and the total equity raise and projected hold period. If any of those terms are unfamiliar to you, don't worry. I'll unpack each one step by step throughout the rest of this video. At a high level, this is a 40-unit property built in 2001, located in Athens-Clarke County in Georgia. It is 100% physically occupied, and we're starting with an offer price of approximately $6 million. With that context in hand, let's move into the summary. You'll see in the in-place cap rate the projected exit value, and a preview of how we plan to force the value from $6 million to $9 million, all over a span of 5 years. And this doesn't happen by magic, folks. We'll also look at the year 1 projected NOI, or net operating income, and walk through how we arrive at those numbers and the exit cap rate. Before we dive in, let me quickly define cap rates and NOI, 2 terms you'll see everywhere in commercial real estate. NOI is simply the money a property makes after paying all of its operating costs, but not including the mortgage debt itself. Think of it like this: collect all of the revenue from the rent and other sources of income, subtract all of that by the bills, property taxes, insurance, maintenance, management, marketing, repairs, everything else. And whatever is left is the NOI. It's the clearest measure of how much cash a property actually generates on its own. The cap rate, short for capitalization rate, is how the market puts a price on that income. It's calculated by taking the NOI and dividing it by the property market value. It effectively answers the question: for every dollar that this property earns, how much is someone willing to pay for that dollar? A 7% cap rate means investors are paying roughly $14 for every $1 of annual income the property produces. A lower cap rate means that the market trusts the asset more and is willing to pay a premium on it. A higher cap rate means that there's inherently more risk somehow, or more opportunity, depending on how you look at it. For me, buying at a 7.76 cap rate and projecting an exit cap rate at a 6.08% means I'm buying this at a discount relative to where I expect to sell it. And that compression alone adds meaningful value. The first thing to highlight is that this property is fully stabilized, meaning it carries low risk. It has a strong, proven track record of consistent physical occupancy and stable rents. All of this, which I can ascertain by looking at what's called at the rent roll, which is the last 12 months of rent and current rent leases that are active. What I especially like about this deal is the proven renovation premium, where the seller had one of the 40 units renovated and it achieved a $175 per month rent increase. translating to a 30% ROI or return on initial investment on that renovation. The market positioning is also strong relative to the acquisition price. On top of that, it benefits from a powerful industrial demand anchor. The primary renter base here includes UGA students, the largest university in all of Georgia. It also includes young working professionals and employees of major regional employers like SK Battery America. This kind of diverse market demand is exactly what I look for to ensure market resilience and sustainable growth. Equally important, all of my underwriting or analysis is done with a strong sense of conservatism. Even though this asset is 100% occupied today, I model and project some vacancy and keep the projected rent growth year over year very conservative at only 1 to 3% annually, with 1% taking place in the early years. The goal is to never rely on optimistic growth assumptions to make the investment work for me and my investors. So how do we actually force value to increase the property price? Let's talk strategy. Value creation here happens through a disciplined renovation program. There's a lot of different techniques one can employ here. They can employ streamlining operations, reducing costs, and other creative outlets. But for this particular example, value creation is going to happen through a disciplined renovation program. I plan to renovate all the remaining 39 units over a course of 12 months. Not all at once, but on a rolling basis as leases expire. I will not renew those leases and instead opt to perform the renovation and then release each unit at a premium rent. The renovation cost per unit is a modest $8,000. I'm not doing a flip. I'm simply modernizing these units with hardwood floors, granite countertops, stainless steel appliances, and updated lighting and plumbing fixtures. In total, the interior renovation across all units has a budget of $312,000, and the exterior budget is only $10,000 to cover fresh paint, signage, and branding updates. Adding a 10% contingency brings the total renovation budget to approximately $355,000. Based on the current rent roll, which is the breakdown of all rent revenue in active leases, I project being able to renovate approximately 3 to 5 units per month. Each renovated unit is expected to generate roughly $200 per month in additional rent, translating to approximately a 30% return on investment per renovation. Now, let's talk about what this actually means for you as a theoretical investor in deals like this. Here are the projected returns across different theoretical investment levels. Each row in the table represents a possible investment amount ranging from $20,000 to $200,000. Each column represents a key performance metric, starting with the cash on cash distribution. This is simply the annual cash profit you would see distributed to your bank account. I track this for years 1 through 4 with a theoretical sale of the property on year 5. The sale proceeds column shows the hypothetical amount you would receive upon that sale, assuming I achieve the projected exit value. The total return column summarizes your cumulative return over the entire holding period. And the profit column takes that total amount and subtracts your initial investment. At the end of the day, the bottom line question is, how much did you multiply my money? The target internal rate of return, or IRR, factors in the time value of money. Rather than simply reporting an annual 6% cash yield and then a large lump sum at year 5, the IRR blends those returns over time to arrive at a true annualized return. In this case, approximately 15%. The charts below help visualize those numbers. Because renovations happen throughout year 1, that year's expected cash distribution is lower than the rest of the years from 2 to 4. But on year 5, that accelerates significantly once the sale proceeds hit. Now let's review the financial projections in greater detail. The first chart shows how the NOI is projected to progress year over year. Year one is the lowest NOI year because renovations are actively underway and we're carrying elevated vacancy as we renew these units. In years 2, 3, and 4, the fully renovated units are stabilized at premium rents, which is why the NOI rises substantially above the current in-place figure. In year 5, I apply a 1 to 3% annual rent increase, deliberately conservative. Looking at gross income versus expenses, income is materially higher than expenses throughout the entire hold period, which is exactly what we want to see. Importantly, I never assume that expenses are going to remain flat. They grow year over year, just like the income does, and by projecting this growth, I ensure that the model remains conservative. In the detailed pro forma table below, each line item tracks year-over-year changes across gross potential rent, loss to lease vacancy, and other income such as utility chargebacks, and the effective gross income, also known as EGI, which is all of that income added up together. So hopefully you're starting to see some of these important terms come together. Once we subtract operating expenses derived from an analysis of the trailing 12 months of expenses, which is called the T12, we arrive at the NOI. From there, we subtract the annual debt service from the mortgage loans to get to cash flow, which drives the cash on cash return. At the very bottom, you'll see property value calculated at the prevailing market cap rate. As we push rent revenue higher through these renovations, the property value increases in lockstep, assuming the exit cap rate remains relatively stable in year 5. Now let's talk about the physical property itself. What makes this asset particularly compelling is that it is a duplex style community. It actually feels like renting a townhome rather than a traditional apartment complex. And that distinction matters for resident retention. This property comes with 40 units built in 2001 with an average unit size just over 1,000 square feet, which is a good size because it's not too small. The construction is brick exterior across 20 separate buildings. Yes, more buildings means more roof surface area to maintain over time and potentially more maintenance, but it also reinforces that home-like feel that keeps residents wanting to stay longer. The unit mix is split evenly. 20 units are 2-bed, 2-bath, and 20 units are 3-bed, 2-bath. That 50-50 split is excellent because it provides versatility across multiple renter demographics, smaller households and families alike. Another strong positive is the significant capital that has already been done on this property. It comes with new roofs, HVAC systems, water heaters, and parking lot paving. If those improvements hadn't been made, they would represent both deferred maintenance risk and a reason to push the acquisition price even lower. The stabilization metrics are fantastic. 0 evictions in the last 6 years, 100% rent collections over the trailing 12 months, and 50% of residents have lived here for more than 3 years. That is genuinely strong performance by any standard, but we have to apply a trust but validate mentality. So prior to theoretically acquiring this property, I would perform a very rigorous due diligence by asking for proof of every single lease agreement, asking for all of the contractor receipts and quotes and scope of work that was performed, and truly be able to verify that all the work that's been put in this property has actually happened at my standards. Lastly, the proven renovation premium. As we said earlier, the seller completed 1-unit renovation and a neighboring resident signed a lease at a $175 per month premium before the unit was even formally listed. That is the clearest possible demand signal that the renovation will produce a quick ROI. Next up, let's talk about the market within this area, because a great property with great financials is not the whole story. It's very important to understand both the sub-market, which is very narrow and specific to where the property sits, as well as understand the broader market so I can evaluate a few key metrics. The first metric is unemployment rate. You want this relatively low because when unemployment is high in a particular area, risk increases. The second metric is population growth in the county. If population is flat or declining, that's usually a negative signal for future demand. And the third metric is supply. If you see a lot of net new development going on, that can create more competition or worse, oversupply, which can pressure rent growth and force more concessions or promotional offers to attract tenants. That is why I track new deliveries year over year in the future, something that a CoStar report can provide to me. If this number is too high, absorption can weaken. Absorption simply means how quickly can the market fill available units. I want to see a healthy, positive absorption rate. Fortunately, the supply pipeline in this market is contracting. It's getting smaller. 2026 deliveries are down about 30% year over year, which supports better absorption rates and over time, stronger rent growth. Now, historically, Athens is still digesting the peak deliveries from 2023 and 2024, so in near terms, vacancy is still expected to be around 6 to 6.5%, and rent growth may remain very moderate at only around 1 to 2%. However, because new supply is projected to slow over the next several years, absorption should continue improving and catching up, resulting in rent growth having room to move higher over the 5-year hold. I also review rent comps and sales comps. Rent comps help us confirm that the projected rents are within a realistic range compared with similar nearby properties, and sales comps helps verify whether the purchase price is reasonable or whether I am overpaying. Another important topic is crime. In Athens, crime is above the US average. That affects resident perception and also your bottom line, because it could ultimately drive higher insurance costs. So this is where you need deeper neighborhood level diligence and a plan for practical security improvements. And finally, one of the most important checks, median household income. You need to ensure renters in that market can comfortably afford the rents that are being projected. If income doesn't support rent, the deal can break quickly, which takes us to the risks section. The first risk is softer rent growth in the short term due to recent supply deliveries. The mitigation for this is to use conservative underwriting like I've done and project low early year rent growth, 1 to 2%. And by adding forced value through renovations, the business plan does not rely on market rent growth for the investment to work. The second risk is related to the renovation strategy itself. I projected about $8,000 per unit, but costs can run higher and timelines can slip. However, the mitigation for this is a built-in 10% contingency and a rolling renovation strategy that preserves cash flow from occupied units while work is being completed on the renovated units. The third risk is related to investor liquidity. Theoretical investors would not get their full capital back before the projected 5-year exit, but it could potentially be longer than that if the hold period gets extended due to unfavorable exit conditions. The mitigation is that cash flow distributions take place right from year one. And as for unfavorable exit conditions, the underwriting I do accounts for a slight increase in market cap rate, which means that my analysis does not rely on market-driven appreciation, but rather purely from value add appreciation. Two very different things. I control value add appreciation. I can control market-driven appreciation. The two lower tier risks are physical asset condition and occupancy risk. For asset condition, the mitigation is rigorous pre-close diligence. This includes performing inspections of the property, hiring contractor walkthroughs, and producing renovation scope validation to reduce surprises. For occupancy risk, the property is already highly stabilized, but I still underwrite conservatively by modeling vacancy instead of assuming perfect occupancy forever. If you want to learn a little more about me, every informational deal concludes my profile. I've been in real estate for over 8 years. primarily focused in the residential market. I currently own and self-manage 8 single-family properties. Because I rent these room by room, that translates to roughly 30 active tenants each year under my direct management. Across those properties, my average cash on cash return is about 15%. Some are higher, some are lower. I personally perform the full operating stack. That includes leasing, marketing, tenant screening, rent collection, and day-to-day execution. All of that experience puts me in a strong position to oversee assets like this one with high quality execution and accountability, ensuring that any property manager I hire for these properties operate at a very high standard. If you found this helpful and want to learn more about commercial real estate or real estate as a whole, reach out to me directly. You'll find my email, website, and YouTube channel all on this page. Let's connect, discuss your goals, and answer your questions, and see what opportunities we identify to work together in the future. In the meantime, go ahead and check out my current and upcoming content and subscribe to my YouTube channel so you don't miss the next informational deal discussion. Thanks as always for tuning in, and I'll see you in the next one.